All right, let's get into this one as well as we did the others. But what I want to do here is continue our ratio conversation and jump right into profitability ratios. As you see here, I don't want to do this with like each one with just a single slide. If you're just listening to this, I hope that actually works. My goal here is not to get into the specific calculations of ratios just in this conversation alone, but to have a conversation about what we're doing so you have a general idea. So you should see that I've posted with these an Excel file. The Excel file contains not only a description of all the ratios, but also them all being calculated for you as well, so that you're not you have that if you want to look at it. But that's you can approach this multiple ways. Let's jump right into it. What I want to do here, though, as well, is on my profitability conversation is to talk about just the profitability that we see on respect to the income statement. And that's a ton of value we want to use here, but let's go through this. First, I mentioned common sizing in the prior discussion, and what you can do there is express everything as a percent of sales. Well, that's kind of the same thing I have here, percent of sales. Just as a reminder, if you want to look at any expense for the company, or any operating expense, I should say, cost of goods sold, cost of sales, general and administrative, research and development, sales and marketing, right? They will vary based on companies, as we've covered with the income statement. But the simplest way to just start off your metrics of profitability is looking at your expenses as a percent of total sales. So how did that expense change the percent of total sales? And which operating expenses can you do that for? All of them. So that's our first stance there, is that when we're common sizing, we're beginning our conversation about profitability. In addition to that, what I want to talk about for the rest of these is actually specific line items that we usually see or could calculate based off the income statement. Now, the difference here is these are going to focus on profits or income, which is just revenue minus a certain group of expenses. And the specific expenses we're subtracting off will change. So let's start. What's the first measure of profitability we usually see on an income statement? It's gross profit, but gross profit divided by revenue is commonly called gross margin, or actually also called gross profit margin. So I want to be clear, for all these I want to talk about as a percent of revenue. You certainly want to think about, the dollar amount, is it going up or down? But when you're looking at it and comparing it across time, it might be valuable to look at it as a percent of revenue. So both understand the dollar amount and also think about it as a percent of revenue. Let's talk about the percent of revenue here. Gross profit, revenue minus cost of sales or cost of goods sold, is our gross profit. Take that, divide it by revenue, and you have your gross profit or gross profit margin. What does that tell us? Just focusing on our core expenses in generating revenue, providing a product or a service, how much money do we make? As a basic litmus test, you could think of this as like just a broad indicator of like unit economics, or contribution margin, as we use in different ways. When we sell each item, how much money do we make? I was going to say this as a litmus test. We definitely need this to be positive, right? If this isn't positive, we don't expect this to be positive, we should question whether or not we should make any of these items. So a negative gross margin is not a good situation to be in. Positive may actually not be the best thing ever, but at least that's a minimum starting point we want to consider. As we hit our stride as a business, are we able to have positive gross margin? Again, meaning the profits we make when we're only considering the direct cost to produce the good or service. One quick caveat here is that there's not one single way to determine our cost of goods sold. So there's not one single way to determine gross profit margin. I'll cover that in more depth later. I just want to kind of highlight that very quickly. Second thing we have is operating profit or operating margin. And this would be revenue minus all of our operating expenses. So it's revenue minus cost of goods sold or cost of sales, general and administrative, research and development, sales and marketing, that kind of stuff, all that stuff. Now, you could also do this as gross profit minus your other operating expenses, but I think it's simpler to just reflect this in its straightforward reality. Revenue minus all of our operating expenses is our operating income. Take our operating income, divide that by our sales, and we get our operating margin. What is that? This is one of the best metrics, profitability assessments we get on an income statement. Clear, direct, straightforward, standardized. We can compare it across all companies. It is the revenue minus all of the expenses of running your business. Now, it doesn't include all expenses. It excludes things like gains and losses, most one-time items, and also interest and taxes, interest income, interest expense, income taxes, income tax benefit, you name it. Those things are separately reported after operating income. So our operating profit or operating margin gives us the ability to look at how did the company's core operations go? all parts of its core operations. As an example here, research and development, right? That may not be directly related to selling your product, so it's not reflecting gross profit or gross profit margin, but it is still a core operating expense. So this would be our revenue minus all of our operating expenses. It's really good because it's standardized across companies, and you can use this as a comparison. It's independent of their capital structure, it's independent of their tax situation, and it's consistent with respect to which expenses go in. So we have a great ability to look at this in whether the company changes or the set of other firms you're looking at are different as well. It's standardized everything. It's company's revenue minus all their operating expenses. That would be their operating profit. Divide that by revenue, you get a good metric for comparison. All right. Net operating profit after taxes, not actually an item that's directly reported on an income statement, but one that we can determine simply by taking our operating profits and then after taxes, meaning removing the effect of taxes. So then we're simply taking our tax expense and pulling it out of there. Now, why would we do that? Well, one reason for doing that is we're simply arguing that taxes are a resource in running your business. And so it's an expense that's not in many ways different from, even though it's not operating, it's not different in terms of resources consumed than research and development and wages and cost of goods sold. You run a business, you have to pay your employees, you have to buy your, incur cost of goods sold, pay for rent, and you have to pay taxes. And so in some ways, if we're looking at resources consumed by the business, taxes are very similar to those. The only thing that net operating profit is kind of not including is one-time gains or losses, and then also interest expense. So it's just going to look at like our components of our business, operating expenses, and our taxes, and how are they leading to overall profit after those things. Last one, net income. Bottom line profitability. What does this represent? The revenue minus everything that we're going to see on the income statements. That's cost of goods sold, other operating expenses, interest income, interest expense, income taxes, gains, losses, you name it. So net income is complete. It's revenue minus every single one of our expenses, gains, and losses. In some ways, which I'll cover in a future lesson, that may not be the best thing to compare across companies. But if you want the complete depiction of what happened in terms of that particular year, net income is going to represent that. So, and you can take this and scale it by revenue as well. But what we're getting out of this particular bottom line metric is revenue minus all my expenses, gains, and losses, like the total impact in that period from the perspective of my shareholders. Much more to do on these profitability metrics. I think this more than any other lesson, I really have to kind of offer a caveat at the end. There are non-GAAP metrics. There are unique metrics that I are trying to be these, just as an example quickly without doing a deep dive. When many people use the phrase EBIT, earnings before interest and taxes, they probably are trying to use or probably mean in a conceptual sense operating profits or operating income. It's just kind of a roundabout way of saying operating income. So there is more to it. I wanted to stick with just what's on the income statement here, but yes, there's different applications, different ways of doing this. I still want to recommend that your best way of assessing profitability is getting your income statement, looking at each expense as a percent of sales, look at each profit that's already reported as a percent of sales, and work in that direction. Can this get more complicated? Oh, yes, it can. Are there other metrics that may have some dubious reasons behind them, even though they're very common? Yes, there are. We'll cover them in a future lesson. But to summarize one more time, if you want to understand profitability, get an income statement. Look at each expense as a percent of revenue. When you're done that, start looking at the subtotals, the profitability subtotals, gross profit, operating income, net income as a percent of revenue as well. Start your assessment of profitability there. All right, with that, I'm going to end this one. We'll pick up in a moment.